Good morning. We will go ahead and call to order our Oklahoma City MAPS initiative or investment and operating trust meeting for August 15th, 2022. So number 2 on our agenda is approval of the minutes. They were included in the packet that was sent out. So if anybody has any changes or modifications, otherwise I'd take a motion in a second to approve. Okay, please cast your votes. Okay, motion passes. Thank you so much. Moving on to item 3, presentation of investment performance review, period ending June 30, 2022. We have Doug Anderson here from ANCO to present.
Thank
Good morning,
you.
Doug.
Thank
Good to see you.
Good to see you. Madam Chairperson and trustees, this is one of the first times that we've had a look at performance, and of course, performance has been very difficult this year, so hopefully this is things are dark before the dawn. If you could go to the next slide here. One thing I want to, actually back one, please. One thing I'd like to quickly point out is something we're very proud of at ANCO. This year, we decided to go all out for the Greenwich Quality Award, which is an industry standard award that ranks folks like ourselves. And what we're very proud about is the first time that we really put effort into this, that we are the mid-size consultant, because we're a mid-sized firm, we're not huge, but we are the quality, what is the exact term? The Quality Leader Award amongst mid-size consulting firms in the country. What is very gratifying about this is that it's based on us versus our competitors, but it's based on our clients. Filling out a survey because we don't have a tangible product and performance is difficult to gauge, but we're very proud of this, and I don't think that we could have done this. We could not have done this without our clients and without them being happy with what we do for them. So very proud to share this with you, and we're working very hard on next year's rating as well. So next slide, a little bit more. Perfect, right there. That is the one I wanted to start on. Just to set the tone for the meeting today, this is as of June 30. This year we have had a bear market amongst equities, which means a drawdown of at least 20% from peak to trough. And you'll see through the second quarter of this year, it was a pretty painful quarter. Equities down more than 15%, 16 to 17.2%. And do notice that all of those indexes, despite pretty different types of companies underlying them, were down roughly the same. That's typical for a panicked environment when everything has to be sold. And in fact, when you look at the month of June, the strongest assets the previous part of that year sold off the hardest in that month. And that sometimes feels like a crescendo in the negative environment of the equity markets. Below that in the gray, you'll see international equities, and those are down pretty significantly also. Emerging markets down 11.4%, developed markets down 14.5%. And the breakout that we're seeing there is that many emerging markets tend to be much more commodity oriented, meaning they have natural resources, and in an inflationary environment, those hold up much better. The developed markets are, of course, hurt by supply chain issues, hurt by higher energy prices. If you're following what's going on in Europe about their energy situation for this winter and beyond, it's pretty scary, not something we've seen in quite some time. One thing I will note, natural gas, which is, Germany uses natural gas for industrial production and for residential power use for heating. As of now, or as of earlier this year, definitely, they were entirely dependent on one pipeline coming from Russia, and Russia's kind of playing hardball with them right now, and they're cutting off the supply here and there. Natural gas prices in the United States are about $8 an MCF, which is very high for us. It's been between $2 and $3 for almost better part of a decade. So far, because of this, it's up to $8. If you try to buy the same amount of natural gas in Europe, the front month contract there is running $62. So almost 8 times as much as it is right now in the United States. So it's good to be a commodity seller, not time to be a commodity buyer right now. If you look at the one-year performance here, you do see some pretty massive dispersion of returns. This indicates that it was sort of a rolling bear market in the United States where large caps held up better over the course of the year. You can see that the one-year performance for international equities off really, really difficult. And then you can see the third set, the green columns down there are bonds, right? Bonds we typically rely on to stabilize the portfolio when the equity market is going down. Most of the time that's true, but this is driven by one of the drivers for the uncertainty was inflation. And inflation is kryptonite for bond prices. So out of all of the first halves of the year that an investor could have endured, going back to the beginning of the 20th century, we're in the fourth worst one, the first half of this year. The only ones that were more difficult for investors in stocks and bonds, right? This is the unique case. Stocks and bonds both going down. 1938, right in the middle of the Great Depression. 1970 and 1972. So those were the only first halves that were more difficult for investors than this one. And obviously those two were inflation, 70 and 72. One next slide, please. We're not going to talk a lot about this, but notice that value stocks are doing better than growth stocks. Value stocks typically are going to be your banks, insurance companies, energy companies, and utilities. So those are more stable during times of technological disruption. And you can see that as we go down in cap size, capitalization size, or company size, the losses get worse, and that's what we expect in the short term. So the next, please. This is an interesting slide here, and this shows the sector breakdown of the Russell indexes for domestic equities. You can see on the left-hand side, the scale of that are the individual sectors, and the number in the parentheses right to the right of each of those is the size or the weighting in the index of each of those indexes. Right? The big standouts, obviously, in the United States is information technology at 27%. That's the biggest sector that we have by cap size. And so far, this for the quarter, it was down 21%. So that's a huge driver in that. And as we all know, technology has been challenged lately as we are focusing more on basic things, right? We're not focusing as much on, the latest update on Facebook or Meta or the latest iPhone, although that's pretty cool. It's not a must-have thing right now, right? It's not. We are looking at gasoline at $4 a gallon, right? And you look at that, and you can see energy over the last year was the best performer, and not by a very small margin, right? Energy sector, although it's relatively small in the index, was up 40%. And if you compare that to, say, financials or real estate, et cetera, all of those, with pretty significant losses, or even consumer discretionary, down 26%, that's a massive delta between those two. Very, very notable and noticeable. But energy was basically neglected by the markets for 5 years prior to this, because the world was going to, and this is both renewable and fossil fuels, but mostly fossil fuels, as the world was going to be green, and the investment markets were like, we're not interested in investing in energy anymore. And they neglect it until they can't, is really what's happened. So next slide, please. These are the biggest companies on the left-hand side, on the upper right-hand side. So the Russell 1000, the biggest company in there is Apple, and it's almost 6% of the index. It was barely positive for the year, but down 21% for the quarter. You can see Microsoft, Amazon, Alphabet, which is Google, Tesla, down 37% for the quarter. Berkshire Hathaway, again, this is typical of a market that's kind of acting in a panicked state, right? It is a state of we have to sell something, not necessarily what we want to. You look at the bottom 10 performers here on the left-hand side, these losses are pretty massive. And what it does, it reflects a number of things, but one of them is that companies are having to pay a lot more for financing right now. Money has been effectively free for quite some time, but now with interest rates moving higher, and lenders out there demanding more income for the money that they are lending out. You're seeing some stress in the financing markets. You can see on the upper right-hand side, the Russell 2000 small companies, healthcare, industrials. There are a few with positive returns up there, but those are the best amongst all 2,000 companies. Next, please. International markets have been difficult, exacerbated by the fact that the US dollar is very strong. If you're traveling abroad, right now is a good time to do it. If you're buying stuff from overseas, a great time to do it, but it's not good for our exports because our currency is so much stronger versus the other ones out there. Next, please. Briefly, this is the index. I'm going to go ahead and roll through this one. But bonds, this is the last of the market environment slides. And this is a highly unusual chart. This is the one, if you had this page that you would ever want to, frame and put on the wall because it was such a good quarter, this is the opposite end of that one. It's highly, highly unlikely that we will see, unless we're in a hyperinflationary market, like truly hyperinflationary, that we'll see bond results worse than this ever. I think that the most interesting quote I heard about this was the worst quarter, or the worst first half of the year, or the worst year for bonds in the United States since the Civil War, which, if you can imagine the economic disruption that had, it puts it in perspective. This is a very difficult time. Now, the great thing about bonds is that they mature, right? So at maturity, you're going to get par back, which is not something you get from equities. But when interest rates are highly unusual like they are right now, it can be disconcerting. Next slide on fixed income. You'll notice here on the right-hand side at the very bottom, this is the yield curve. So this is the cost of money, or effectively treasury yields. And the yield curve is now slightly inverted, which is a predecessor or a precursor of recessions. Not always. Recession ensues, but the market is expecting a decent slowdown in economic activity. And the upper right-hand side, this is yields in the marketplace. So the very bottom one there is that gray bar, and it's a bar because the Federal Reserve sets a range of the target interest rate, Fed funds rate. You can see it's been at effectively 0 to 25 basis points until December of last year. And you can see that the Fed has been very aggressively raising interest rates to fight inflation because we haven't seen it in a long time. And it feels shocking at some points. So that's market environment. If we can go quickly here, again, this is a very young fund. Remember, we started funding earlier this year. You can see inception at the end of March. If we go, the beginning market value of 40 million contributions total, and giving an ending market value of $71 million. And I know that the initial market value is very, very important on this. Next slide, please, and we're watching it carefully. So notice not a lot of change here. You can see equities fell off a little bit because they were down more sharply than bonds were, but a very short period of time. And next, this is our asset allocation. The allocation did change as equities went down more than fixed income. International equities, you can see that they topped up during the quarter, and you'll also notice that market value went from 40 to 71 during the quarter, and that's cash flows. Remember, at the very early stages of this, we decided that even though we would get the $80 million all at once, we would put it to work in 2 tranches to sort of mitigate that one-day risk, and it was helpful. In retrospect, the perfect way to do this would be hold on to cash for a while longer, but we're not in the business of market timing quite to that extent. So next slide is our allocation. Remember, we're a fairly simple portfolio, and I think right now simplicity is best. It's not overcomplicated, it's inexpensive, and it is very targeted in the assets we're investing in. And next slide. One more, please. I'm going to go straight to performance here. So for the quarter, and we started measuring performance on April 1, so the quarter and the inception are exactly the same, 11.84% loss. The ending market value at the end of June was $71 million. So you can see it was down pretty significantly. As far as first quarters to be investing for a fund like this, we could have picked a better one, but I don't think that we had the choice. We put the funds to work. You can see as we go down the list for the quarter, and the fund returns are much longer because they're mutual funds. This is not the returns that we had, obviously, so the quarter return is what we see. The equity on the domestic equity composite is down 16.5%, and you can see all three of our investments, the Fidelity Index Fund, the Vanguard Mid Cap Fund, the Vanguard Small Cap Fund, were down very close to one another. Again, telling us it feels like a panicked market environment at that time. You can see our international equity portfolio is down 13%, and even our fixed income portfolios, the ones that were supposed to help stabilize the portfolio during a difficult market environment, you can see that those are down on the quarter also. High yield bonds being down 9%. So again, a very, very difficult environment. If we look at ourselves versus our benchmarks, obviously the 4% annualized spending rate, we're nowhere near that for the first quarter that we invested. We're a little bit worse than the all public plans total fund median. If we go down the individual funds versus their benchmarks, you can see the Fidelity Index Fund right on its benchmark, the other two index funds right where they should be also. The International Index Fund was better than its benchmark, and that tends to happen pretty frequently. But you see that our Dodge and Cox and our Prudential high yield bond portfolio are very close to their benchmarks too. Now, over the long term, and again, these are not returns that we realized, obviously, but if you look over the long term, the 10-year column there, again, this is for illustrative purposes, you can see that the funds are doing what they should also over long periods of time, and they've ranked pretty strongly within their peer universe. You do that on our active fixed income portfolios, and you can see that they've done very well versus their peer benchmarks. So next slide, please. Cash, there was some cash in the portfolio, which helped a little bit, but not a lot. And then next. I don't think I'm going to skip too much. I'm not going to spend too much time here. Just noting that the number in the parentheses next to the return is a peer universe ranking. So it compares the fund that we have versus relevant peer managers to it. And first is the highest ranking that you could get. 100th is the lowest. So notice that most of these returns are fairly, they tend to be top quartile or above. And that's the reasons that we selected some of these. Next slide. I want to go ahead and do a big page jump and go all the way to the fees, which, let me see, Mitchell, that's about page 34 or so. So page 34, this shows what the fees are. Again, we don't know what performance is, but this is about the only thing that we can really count on. So 18 basis points is our total weighted fee, which is very attractive. I would say for funds like yourselves in this, it would be, the average is probably well above 50 basis points, so we're significantly less expensive there. And you can see that the estimated annual fee, the highest one is the bond portfolio. It's actively managed, but at 42 basis points, it still adds up to $87,000. And with that, I'll conclude my remarks and happy to answer any questions about the second quarter report.
Any questions for Doug?
Just a couple of comments. First of all, I wanted to pass on our appreciation for the efforts that your firm has made in regard to the Greenwich Award. I think showing a high level of competence only serves to make the folks that we answer to feel that much more comfortable that we're in good company with ANCO. Another question I had was, I know that in regard to inflation, we have limited supplies, prices. You had briefly touched on supply chain issues, and that the fact that they're not just our supply chain issues here in the U.S., but they're global, also related to the Ukrainian conflict, and also know that we have issues, with the supplies coming out of China as well. I know that has a big impact on inflation, or the inflation that we're seeing. Does does your team feel that that's going to be going on for a long time, or do you feel like it's in a foreseeable future that we might see some reduction in those supply chain issues?
That's a great question, and it's one that's really kind of at the heart of everything right now. I would say that we don't necessarily have a firm view on inflation, other than it's here right now, and the response to inflation will be very interesting. What's happening? Now, I will say that there are times when it's good to be a commodity buyer, and there's times it's good to be a commodity seller. And we're definitely in the environment that it's good to be a commodity seller, right? If you have natural resources, you are definitely on the right side of the trade right now. So, for instance, where we live, it is a good time for Oklahoma economically because of oil, natural gas, and foodstuffs, right? Amongst other things. But what if you're another country out there that, like Japan, that has to import all of that stuff? That's very difficult. So inflation hurts them almost exclusively. It's almost exclusively pain for them, right? But because we're selling, inflation is sort of it's biased to hurt consumers, which we all are, but it helps producers over some time. And there was some talk about corporate earnings being pretty strong in the first quarter because companies really got out ahead of it and said, we're going to raise prices. So from corporate America's standpoint, it will be interesting. Global macroeconomics is not something that you can reliably build short-term investment theses on, but I will say that I was talking to a colleague of mine that has been around the block a few times also, and we were talking about it, and we're trying to, we both had these thoughts of what does this environment look like? What does it remind you of? And the one that we came to agree on was, if you think back to the late 1980s, and you had the rise of Japan and Germany at the same time. And I remember this very clearly because the United States economy was about to be eclipsed by those two and other economies around the world, and it felt a lot like China, right? The China that we're looking at right now is they're huge. They have innovation, they have people, resources, but they've got a couple of things that are pretty similar to Japan. One, they have demographic issues. They have real demographic issues. They don't have replacement for the people they have. It's the most rapidly aging society or country in the history of the world, and that's challenging. They do have commodities that they can do, but they also have some issues with real estate leverage and with banking right now too, and supply chain issues. I think I read last night that another 1 million people were locked down by China yesterday. And it's not a huge part of their population, but it's troubling in a way. So as far as inflation goes, it's going to hurt, right? Gas prices have come down some, but I think that this winter will be a very difficult time to be a commodity importer. I would not want to be there. And for all of that. So it's good to be sitting on top of some natural gas right now and some oil and even the renewables that we have. It's a better place to be. But I'm back in my mind, I'm thinking my gas bill is going to be really high this year. And I don't have a way that we can take advantage of this here. I will say one thing, and this sort of loops in the inflation issue you were talking about. So for years and years, we've talked about bond yields are very, very low. We need income, but is there something we can invest in that will provide income but not get whipsawed by inflation if it comes around? And the easiest answer for the last 5 years has been real estate. And so real estate's garnered a lot of assets for institutional investors. And what I'm talking about are office buildings, multifamily, warehousing, and it's evolved a bit over the last 5 years. Not a lot of retail. Nobody wants to own malls or retail anymore. But it's evolved. But last week, one of the big real estate managers, they have these massive things that are called core real estate funds. One of them, which is their right to do this by their documents, they said, we're not going to be allowing withdrawals for the next 6 months, at least. Which tells you that there was the starting of a run on the bank, because real estate values lag because they're only appraised every quarter or every 6 months. And so if I look at the rest of my portfolio, and we just went through that painful experience just now, but then I look at my real estate portfolio and it's up 20% over the last year, and I need to pay some bills, well, I'm gonna go straight there, right? That's the only place I can go. But they're saying if you do that, it's going to force us to sell too much of the property, and it might have a negative spiral on this. So we thought about real estate in this portfolio. It may have a role in the future. I would not want to be trying to get money out of real estate right now. So unintended consequence, maybe.
One last question. This is more for Teresa. With the decline in the overall market value in our portfolio, I'm assuming that means that there will be no allocations until we get to the point to where we're actually, the value goes up. Are the programs prepared for that? I mean, are they expecting anything anytime soon?
So the good news is most of the programs and projects that are slotted to receive allocations from the trust will not go online probably until 25, maybe one or two maybe in 24, but end of 24 and 25. So we've got a little time for Doug and his team to do some magic. So that's number one factor that I think it plays in our favor. Number two, to answer the first question, the way that the trust indenture is written, it cannot go below that corpus. And so that's the answer. We probably do, as I was, listening to Doug's report, I thought, the MAPS office, we probably need to pull in some of those programs, some of those projects, and start having that conversation, kind of letting them know where we are and how they can plan for that. So, good question.
Doug, quick question. I second Bob's comments in regard to the great work that ANCO does, as always. I just have a question in regard to the managed funds. If you look on, I guess it'd be slide 18 and then slide 34, just trying to understand what is ANCO's level of expectation of outperformance for the managed funds? Like how high above the benchmarks do you expect the managed funds to be in and to I guess, balance out the fees that are charged by those managed funds? If you compare the outperformance on slide 17 to the fees charged on slide 34, or I guess page 34. Just understanding how you guys think about that internally.
Absolutely. I'd say the first thing to say about that is that we're incredibly cheap with our clients' dollars. We're not going to invest in something that we think will be a money loser versus the index and have to pay active fees for that.
And I think the other thing, maybe I guess the only caveat there is obviously, as you pointed out, we've invested at a time when the market was fairly turbulent.
Yes.
So I certainly understand that. More generally speaking, just understanding the firm's expectation of, hey, if we're investing in managed funds, we expect the alpha to be within a certain range.
Sure, and it's different by asset class. So Dodge & Cox Income Fund, I would say net of fees, after we pay all the fees, I think 50 to 100 basis points per year is reasonable. And in turbulent markets is the time that they tend to shine, although everything sold off at the same time this year. For the high yield fund, I expect it to be net of fees, at least 100 basis points per year, and in some cases it can be significantly higher. I will caveat that the way the index is constructed makes it impossible to invest in the index itself. And there's a reason why. When a bond is downgraded, right, when one of the holdings in the index is downgraded or defaults, especially if it defaults, it exits the index with zero loss to the portfolio. Obviously, if you hold that bond in a real portfolio, you're going to see a significant drawdown. So that benchmark is really, really tough to beat at sometimes. But I do expect it to outperform. If you look at the 10-year figures here, these are all net. So if you look at that, I mean, that's a bit where we are. It's been tough to manage core fixed income because spreads have been really narrow recently. But that situation is changed. And now opportunity to outperform is higher than it was recently. That's a great question. Thank you.
No, we see the same thing in our line of work where the benchmarks, they're very vague in that not all managers report every single time. And sometimes only the best managers report, so you can never get a good sense of what the benchmark is even telling you. Anyway,
Yes.
and at least in what we do.
Yes, I mean, that's important. I mean, the benchmarks we have are fairly simple here, right? You'll notice that like the Vanguard, for those funds, it's a spliced mid-cap index, and that's because they changed indexes a while ago, and they have to splice them together. But at the end of the day, our real benchmark is 4%, right? That's something that we always have to remember. And if I look at this, the 10-year figures there for all of those returns, with the exception of Dodge and Cox, they all helped, right, over that entire period of time. But that does also disguise quite a bit of volatility through that history also.
Great.
Thank you. Any more questions about the quarterly report?
Any other questions? No. Okay, thank you. So now we'll move to item 4, receive the monthly investment flash reports as of April 30, May 31, June 30, and July 31st.
So in order not to relive the pain of the June 30 period, we're going to skip straight to July 31. Next slide, please. And if you look at the returns here for the month, those are all positive. On the upper left-hand side, you can see that the S&P was up 9%, Russell 2000 up 10.22, Russell Growth Index is up 12% on the month, the value up 6.6. All the equity indexes except for emerging markets were positive, and emerging markets were down modestly. You can even see that the fixed income portfolios, those are massive returns for 1 month for a bond portfolio. Bless you. The corporate high yield index is up 5.9%. Remember, we do have a targeted allocation there. I will say that moving forward, we'll be thinking about diversifying fixed income portfolio, an additional step. To put some better hedging qualities in the portfolio, but we're going to let the market kind of settle for a little bit before we do that. If you look at the year-to-date sector returns, it's very similar to what we saw. Energy up 44%. The best sectors so far year-to-date through July. Communication services down 27.57. If you look at interest rates, where they are right here, as of 7/31, the 3-month yield for the 3-month T-bills 2.3. The government 2-year, the U.S. Treasury 2-year Treasury is 2.88. And then notice that the 10-year is at 2.65. If the 10-year bond has a lower yield than the 2-year bond, that means that there's a yield curve inversion, and the market is expecting, or is projecting, I think that's a good word, projecting the high potential for recession in the near future. Looking all the way out at the 30-year at 3.01, which is interesting when you compare it to the column right next to it. At the beginning of this year, before the inflation really hit, before the war, before all the volatility that we had, the 30-year Treasury was at 1.9%. Over the last 2 years, you can see it's almost doubled the yield there. So that's a significant move. On the right-hand side, you can see currencies. If you look at as of 2 years ago, the cross rate from the US dollar to the euro, or euro is officially, or $1.22 for every euro. Right now, it's almost parity, which is it's unusual to see that. And then down to our commodities here, all of them up significantly. Oil, $98, gasoline at 4.2, natural gas at 8.23, which if you go back to just the end of last year at 365. And remember, this is US spot. European spot is $62 right now for the same thing. You can see gold has not moved much despite the inflation, but commodities at 261 versus 166 2 years ago. So that's wheat, that's all the commodities out there, energy, et cetera. So commodity prices are definitely up. Next slide, please. Here's the allocation. Note the market value at $75.7 or $75.8 million. 1 month on, this is what the recovery, this is why we stay fully invested. Next slide, please. For the month, we're up 6.29. So that is, the loss since inception has gone down to 6.3. So we made up half of the loss so far in that 1 month period of time. Our equities are all up better than 9%. Our international equity portfolio is up 3.7. Again, US equities just outpacing international by a significant margin. And our fixed income portfolios did awfully well too during the month of January and of course the quarter to date, because it's just 1 month and it's based on calendar. So this is why we stay invested. I did spoil this, but as of last night, the market value is up to $77.66 million. So we've even made a little bit more progress on that. So again, when you have the worst first half of the year as your start point for your investment portfolio, only could have been 4 years prior to this one that would have been more challenging so far, or going back to 1900. But again, managers are strong, the portfolio is well constructed, and as the markets come back, we've participated pretty fully.
Well, maybe, Doug, that means that we've taken our pain early and it's going to get better from here.
That's
what I
right.
tell myself.
I've got a good set. Yeah, they took the medicine very early on. But again, if there's no potential pain in an investment, there will be no premium for the return. Risk is always present. And the way that we deal with it is stay calm as much as possible, stick with our long-term plan, and spend time thinking that way.
Well, that's what trusts are. We are a long game. So.
Yes.
Any questions on this final report? Okay. We need to take a vote to receive these reports. We'll take a motion in a second. Please cast your votes. Thank you. There we go. Motion passes. Thank you. Thank you, Doug. And we, as has been expressed, we genuinely appreciate you and your team and your diligence.
Very
It's been
good.
a
Thank
very,
you.
very difficult market, but you're doing us well. So thank you.
Thank you, Madam Chairperson and trustees.
Thank you. Okay, moving on to item 5. We need to ratify 5 claims. They were included in your packet. The total is $49,398.47, of which $49,000.08 is for investment consultant services for ANCO, and $398.39 is for the custody bank fees. So any questions? Okay. Otherwise, take a motion in a second. Okay, please cast your votes. Motion passes. Thank you. Okay, moving on to item 6, items for individual consideration. Item A is the renewal of the agreement with ANCO Consulting, LLC, for investment consulting. The cost is estimated at $62,500 for September and that's monthly through September 6th, 2023. This is the second year of a 5-year contract. So any questions about renewing this agreement? Okay. Take a motion in a second. Please cast your votes. Motion passes. Thank you, Deb. Okay, moving on to item 7, reports or comments from trustees, staff, and interested parties. Do we have any comments or, okay? Nothing from staff, anything from the board? Okay, great. Not, we'll move on to item 8, adjournment, and we are adjourned. Thank you all so much for coming today and participating.